from the very basics. We have introduction. What are charts and how do we read them? So it's going to show the difference. And maybe this applies to some of you as well. I'm sure there are some people here who have very little experience. You don't want to take for granted, and it's easy for me as an experienced trader to take for granted what it's like on day one. So even something as simple as when you load up TradingView, because this is what I've been doing. I've been going through and putting myself in the shoes of a newbie. And say if I loaded up TradingView and I saw this, I wouldn't know what the fuck it is. What does it do? What does it mean? Right? And so what's important are the two things: candlestick charts and line charts. Because when you look at this drop down, if I just let somebody loose on TradingView, imagine how confused they'd be. The very first thing that comes up is bars, like an old boomer from the 70s plotting out a chart in his fucking journal with a pen and ruler, right? So I explain, no, we use candlesticks. You can use either hollow candles or regular candles, and line charts. That's all you need. Forget all this other shit. It's just designed to fucking distract you, right? So we give an overview of the market, overview of how to actually look at a market. And then I break down from the very fundamental, what is a market? How do you analyze it? I could not have gone back further to be more ground level on this. This was painstaking for me to figure out and put it together in the order that I would want to learn it if I was new. So I introduce you first to price action analysis. If you've heard me say the term price is everything, this is what this lesson is about, right? Because all the other stuff, and you'll notice if you're perceptive, if you've got perspicacity in this stream, you'll have noticed that module number 5 is indicators and data. Everything here is put in order for a specific reason. Indicators and data should come after all your TA and all your psychology and mindset. Another little trick for anyone who's on this stream: psychology and mindset is actually the most important thing. It should be module 3, right after the basics. But people want to see technical analysis first, right? And so you can have technical analysis first, but you're going to realize very quickly that you need the psychology and mindset modules. You already know this, but some people need to find this out the hard way. Not the hard way, but they need to find it out by testing. This is going to see who actually listens to the lessons and who doesn't. Because in the lessons I very clearly state, from module 2 or module 1, you should not be using real money to trade yet. Not until you've at least gone through the lessons. And if you are gonna, you should be using, like I say often, like $1 of risk. But what's the point of even dollar trading if you don't understand even how to chart yet, or the mindset, or all of that? So trying to get people to really understand that it's not a sprint, it is a marathon, even as a short-term trader, not a short trader, short-term trader. So I introduce you to price action, tell you that price is everything. We talk about direction and path. These are the first 3 modules because they're the things that I see most traders slip up on. Right? Most traders slip up because they don't understand price action and what price means. The reason that indicators are module 5 is because everyone thinks that there's an indicator that will tell them where the market's going to go. But in reality, price never lies. Your indicator can be telling you that we're going to the moon. But if price keeps going down, the market is going down. You don't fight the market. So you listen to price first. And hopefully this new module will help people really crystallize that in their mind so they can truly understand it. It's a very simple thing to say, me saying price is everything. But I understand that it's not something that will make sense to you on the first time you hear it. Right? The best analogy or the best fucking, what do you call it? Like the best phrase I have for it is that price tells you what is and data tells you what if. Any other analysis will tell you what if, right? But price tells you what is. Meaning, if Bitcoin's $27,055 right now, that is the fact. That is what's happening with price. If I go to the Bitcoin chart and I look at it on a 1 hour and I put it on here, let's say I go on a 4 hour, right? And someone wants to tell me that they're super bullish, I'll say, okay, but price is bearish. Price is making lower lows and lower highs, right? Price is everything. It doesn't matter that it's forming a bottom, seemingly. It doesn't matter that funding might be negative. It doesn't matter that apes could be going mad short and we're about to squeeze them. Price is still bearish. So you listen to the price first. This is why if you've been watching my trading analysis or my daily levels from today, you'll know that I think this is a bottom, yet I'm not long. Why is that? Because I need to see more things to convince me that price is bullish, but it's not. Price is still bearish. I don't have enough confirmation yet to start confidently entering longs, right? This might sound simple, but if you could just actually have the discipline to not trade your opinion and trade what the chart's telling you, you would probably double your win rate overnight. I'll say that again. If you could not trade your opinion and just trade what the chart is telling you, you double your win rate. That's very important because as we go through this, that shouldn't be on log chart. As we go through this, you'll see, and this is in, I touch on it in the styles of trading about mechanical and discretionary. So basically systematic versus discretionary. Nobody that's on this stream or that's in the university or that I've spoken to, nobody has the right to be a discretionary trader until they've earned it. You can only earn it through years of screen time. Before that, you should be a systematic trader. And it might sound, I don't know, it might sound weird, but anyone here, if you've got a background in math or science, you'll probably get this. If you're an engineer, you trained as whatever, computer science, you'll understand about how what the chart is telling you, what the price is telling you, what your analysis is telling you, the things you cannot deny, areas like zones of support and resistance, volume at those levels, how price is respecting the principles that are taught, such as the Wyckoff, or even this one where it's 75% retracement from a low, right, up to the 75. Whatever the specific concepts are, techniques, price action, candlestick analysis, volume analysis, all these things that are proven to be better than just you at predicting price, right? That's the whole point of them. Some of these things give you better probabilities than just saying this looks bullish or this looks bearish. Because that at its core is what discretion is. And you should seek to remove all discretion from your trading until you've earned it. Not because discretion is bad. I use discretion all the time. But it's because I know how to use it. And that's not me coming and saying that I have secret knowledge that you don't. I'm just saying that I never enter or exit a trade because it looks bearish or looks bullish. The discretion, which is you essentially overriding your system, only comes from screen time. And it's never a case of, I'm going to take this long because I think it's going up. It's only ever to be used with your system. Discretionary trading goes along with a system. Let me give an example. If you had a RSI at 30, right? You had a market structure break on the 4 hour and you entered on the retest of the market structure break. Okay, let's imagine that's your very simple systematic approach. 4 hour chart, RSI hits 30. We then have a bullish market structure break. I go long on the retest. That is systematic. Those rules can either be met or they're not met. There's no objectivity. There's no subjectivity. It's completely objective. It has to hit 30. That's a discrete thing. You can measure that. RSI hit 30. We have to have a market structure break on the 4 hour. You can measure that. Candle close. That's all you need. Retest of that level will be whenever price touches that level again that it broke. You have an order set and you enter. Very simple, right? Stop loss goes below the swing low. Swing low is always going to be there because we've had a market structure break. There has to be a swing low, right? And then your target, whatever, your target is open for another, throw in another rule, whatever. Your target is the swing high, okay? The previous swing high before the breakdown, whatever. The point is, all of those things, you could plug them into a system, and you could plug them into if you had sophisticated enough data analysis, and maybe you can with AI. Also, someone remind me to talk about AI in a little bit, please. I've got some interesting, cool news for you. If you could plug all that stuff into a supercomputer, it could actually interpret it. Because none of it is down to what you think or what you feel. It is systematic, right? I can't stress this enough. You have to be able to trade like that before you add any discretion. So the problem with people who come in discretion is they think going long now, going short. And I know, I like how they get trolled in the chats with the why meme and all that. Because yes, you should get trolled. Because you're clearly showing a lack of discipline, a lack of understanding, and really at best you're inexperienced, and at worst you're arrogant. And both of those are not good if you don't listen. Nothing wrong with being inexperienced, but you have to be attempting to get better. And so the point of that is discretion. How would I use discretion in a system? Let's explain that. I would see the RSI hitting the 30, right? And I would see the 4-hour market structure break. And then I would see the retest. And I might enter, instead of entering 2% risk, I might enter with 1% risk because it's a CPI day. And I know that on CPI days, often technical setups fail. I don't have exact data for every CPI day in history, so I can't plug that into my system, right? I don't have that, but I know from my own lived experience that you get weird outsized moves on CPI day that can wreck technical setups. So the discretion there was simply to use half the risk, 1% instead of 2%, but you notice I still used the exact same system. Not just saying, I'm going long because Elon Musk tweeted about Doge, right? That's fucking retarded bullshit. So I can't remember why I was ranting about that. But it's very important. If I rant for that long, it must be important. Direction versus path. Well, that was probably a rant about price being everything. Direction versus path, very important as well. So people say that and this is the toughest thing to overcome when you first start in trading, right? Because you normally start, if you are lucky enough that your first ever interaction with trading is in the real world and you join the trading campus and you go through this from the beginning, well, wow, you're the lucky one. Most people aren't that lucky. Most people fuck around by themselves, and this isn't me taking the piss. I done the same stuff. I learned the hard way. But they see stuff. They go on YouTube, they go on Twitter, they go on, please God no, but some of them go on TikTok for their financial advice. And they hear a bunch of opinions, and you have to understand that direction and path are not the same thing. Okay? Direction, this is turning into like a lesson about lessons, but I'm not going to do mini lessons on everything here. Every lesson will be uploaded, yes, GFFUE. So, that's direction. Right, I should have had an arrow. Where's my arrow? That's direction. Okay? That's your guy on fucking Twitter who says Bitcoin's going to 50k. Or whatever. Select coin, select random price target, and tweet it out. Because that's all that matters to them. Because all that matters to them is engagement. Yeah? They just want likes and retweets. So they tweet what is popular. Then, this is the path. So at that time, price was, let's do it. Let me do this right then. I'll drag this up so that we get a nice, crazy move. Let's say we go from 35k to 50k. All right? Price going to 50k. So let's say 40k to 50k. Because I need to do something, right? There we go. Influencer shills this. Price, oh, Bitcoin's going to 50k. Okay, great. Here's what actually happens. Price goes up. Price goes way down. Then price gets to 50k. Influencer comes online and says, see, I told you. I was right. Collects his clout. Even though he probably tweeted about it here at 44. All his followers aped in. It nuked to 34. Of course they all got wrecked because they used leverage. And even the ones who used spot probably sold because it was such a big move and they panicked. Then it goes all the way to 50 and he says, ha, I was right. Please do not, if you take one thing away from this stream, it's going to be in the lessons anyway, but do not focus on direction. Focus on path. It's okay to it's okay to have a view of direction. It's okay to say, I think we should go to 40k. But you have to consider not just the path you want, because when you're planning your trade from 40 to 50k, this is the path you want, right? That's the path you want. This is the path you need to consider. And this is also the path you need to consider, right? I guess I should put that in a different color. This is what every trade should really look like to you. Whatever you're planning, you should think more about what if you're wrong than if you're right. Because it's very easy and it's part of the human condition to look for confirmation bias, to want to be right. And so you say, well, I'm bullish. So you immediately look for bullish confirmation of your bias. Yeah? This rant is almost more in depth than the direction and path lesson, so I'm going to stop. Just watch the direction and path lesson. Bitcoin dropping down a bit. Let's see. This is a valid retest. So, you know, but on a side note, because someone's probably going to ask me, I believe this is selling climax, and this was the AR. This was the ST. This can also be a T. So if we're in phase B, so there's phase A right up to the ST. So phase B started here. This is a valid test. Remember what phase B is. Phase B is generally longer than phase A. So phase B is longer than phase A, and it just tests both sides. Okay? It can do upthrust actions. It can do sweeps to the lows. But phase B is just generally where it tests both sides multiple times. Right? Thank you, Pepe Crypto Quinto. I will do the AI opinion. And thank you to Ahmad as well for that. All right. So anyway, I'm not going to go through every lesson like that. Then we talk about the 4 market phases. Accumulation, markup, distribution, markdown. I talk about how trends start and end. Very, very, very important. I talk about what is a trending market. What is a mean reversion market? There are 2 types of market. You can only trade one of 2 ways. You can trade a trend or you can trade a range, mean reversion. Understanding that can be the difference between being unprofitable and profitable. Because trending strategies don't work in mean reversion and vice versa. Mean reversion strategies don't work in trending markets. I'll teach you how to trade both. We then summarize those. Then I go into waves. The very nature of how price moves is in a wave form. And I notice that everything's crashing just as I say this, so let me go check. Getting a little distracted here, but I wanted to have a look at Litecoin.